Hello and welcome to SwitzerTV Investing. I'm Peter Switzer and it's hunting season. Yep, stocks are going to be on display with reporting season and it's a good time to hunt around for stocks that might be worth buying or selling. On tonight's show, we'll look at those stocks that you should watch over reporting season, and it's just started the reporting season. The table on the screen now shows you the top quality companies that have big possible returns ahead if the analyst experts are right. I wrote this up on today's Switzer report. The first 10 have smaller promised returns, but they are better bets to return a nice windfall once a vaccine or successful treatment for the coronavirus comes to town. Have a look at some of those returns. Vicinity Centres, Centre Group, Horizon Holdings at 22.7%, Sydney Airport 17.8%, Westpac 19.2%, NAB 20.4%, and Qantas 35.3%, Worley 39.4%. These are well-known quality names. Under pressure right now, if you're buying for the future, they have a lot of potential. Now, let's go to the second grade group of companies. These are more risky. The returns are spectacularly higher, but they will have some troubles. We don't know whether companies like Webjet or Corporate Travel will survive these tough times. I suspect they will, but it's a bit of a gamble, and that's why their promised returns, as judged by the analysts and experts, are so high. Nine Entertainment, a company under pressure with the internet bringing Netflix and Disney and Stan and all these other rivals to a free-to-air station. 41.4%. If they get their act together and they do well over the next couple of years, there could be a potential return there. And Star Entertainment Group, that's a gambling or a casino outfit, clearly missing the Chinese tourists, but will Chinese tourists be back in a year or so? If they are, that 34.8% might be something you can pick up if you're prepared to take the risk, and it is a risk. And if you want to know more, as I said, check out the Switzer report, that's switzerreport.com.au. And if you're not a subscriber, you can take a free trial for X number of days. Also on the show, pinpointing stocks to watch is Adam Dawes from Shaw and Partners. And we have a very special interview with the CEO of Fortescue, Elizabeth Gaines. Ever since she joined the company, the share price has been heading in the right direction, and so has the bottom line. And Julia Lee from Birmingham Invest, while our own Paul Rickard tells us whether it's too late to make money out of Afterpay. That's the show ahead, so let's catch up with Julia Lee. Well, as always, we catch up with Julia Lee at the start of the program. Julia, good to see you.
Great to see you, Pete.
Reporting season, this is excitement plus for a girl like you. What are you expecting with reporting season? What are the key things you're looking for?
Christmas for analysts, I call it. But unfortunately, it looks like there might be some nasty surprises this reporting season. First off, we are expecting to see a pretty bad earnings season. If you have a look at consensus for the Australian share market, expecting to see negative earnings growth of 15.5%. Some of the areas investors would be very familiar with. For example, transportation earnings is expected to be down 58%. Also, if you have a look at infrastructure, we know we haven't been using airports as well as toll roads. So that's expected to see earnings down about 62%. One bright area I think will be the resources area, given the iron ore price strength as well as the production we've been seeing coming out of that space. But on the flip side, banks will see earnings decline by around about 30%. So it is going to be a drama-filled reporting season. This week, of course, we hear from the likes of ResMed, Nick Scali, as well as Mirvac. I think Nick Scali will do well, given that people have been spending in the home category, being in lockdown. However, the outlook's also important, and today we saw the discretionary retailers sold off because non-essential retail will be closed over in Melbourne, or is closed, and that's going to have an impact not only on companies like Nick Scali, because you can't go to the showroom, but also on discretionary retailers as well, whether it's Lovisa, JB Hi-Fi, Harvey Norman, all of those will be closed.
But Julia, let's just talk about what's well-trained investors like you might be thinking. Are you thinking then, the market will sell off short term? Why would you be a potential buyer at some point of these on the basis that, well, after 8 weeks, hopefully Melbourne will go back to at least stage 3. and maybe by Christmas it could be stage 2. What is your thinking, just for my viewers who aren't experts like you?
Sure. I think the key here is I look at it on a short-term, a medium-term, and a long-term basis. And there are plenty of opportunities on a medium and long-term basis. And I almost think of myself in 2 years' time looking back at this market and thinking about what I wish I had bought. So there's, I guess, it changes my view from a risk perspective, not to be bogged down on the short-term implications, but looking more medium to long-term, because COVID-19 won't be the dominating factor of markets over the next 5 to 10 years, although it is now. And every day we inch closer to a vaccine or treatments that are going to help in this area. So I think it is a fight against time. At the moment, when you're deep in the trenches, it feels like lockdown will be the reality forever. And I really do feel for our Melbourne friends. But the reality is that in 6 weeks' time, the situation should be a lot better. So look, at the moment, the banks are selling down very heavily. I think it is a negative environment for the banks, given that a 6-week hard lockdown is going to make it more difficult for investment, businesses, especially small and medium enterprises, as well as the job situation. So the banks, as a derivative of the Australian economy, things aren't looking too crash hot there. Of course, the migration to online is once again going to speed up, and today we saw Kogan up by about 8%, Temple and Webster doing well in a sea of red, which was the consumer discretionary retailers. So look, there's short-term positioning in this market, medium term and long term. And I guess going into reporting season, it is all relative. If the market expects a profit result of 100 million and you deliver 200 million, it's going to be really happy. But if you deliver $20 million, even though it's double the profit from last year and was expecting 100 million, of course the shares are going to fall. So it's important not just to look at the profit results, but also market expectations and what's priced in, and also the outlook, because the market is more worried about the future than it is about the past.
Okay, do you want to share with us the companies that you think are going to do well and it might be worthwhile getting in before they report?
Well, obviously all the stocks in my portfolio.
Yeah, of course.
3 that I really like in the portfolio at the moment that I think will outperform during the reporting season. Look, I think property is going to be a drama-filled area and a really tough area, especially those REITs with exposure to shopping centres. For example, Vicinity Centres, about 40% of its revenue comes from Victoria. So I think that will continue to be under pressure. We've also seen negative revaluations there for the June half of about 11%. But I think those negative revaluations are going to continually be a theme. And then, of course, the office sector has been impacted as well. But stocks that I do like in that space, Goodman Group, still benefiting from that migration to online, and Charter Hall Wales, which we do own. So 14.5 lease. And this is one of the few REITs that we've seen in the property sector seeing consensus upgrades. Most of the companies in this space are seeing downgrades at the moment. So we own Charter Hall Wales, but I think it'll continually be a good one in that property space. Look, at the moment, you're seeing a lot of buying go into Coles as well as Woolworths. But in this type of environment, I think, it's one of the smaller companies that could outperform, and that's Metcash. So we own a little bit in Metcash, and of course, as lockdowns take effect, people will be shopping local. So Metcash should be a winner there as well. And look, super retail, we think that the after parts market is very strong. We saw that in terms of some of the results that have already come through. And look, I guess the look through is positive on the stock that we don't own, which is ARB. But super retail, we already got a taste of what's to come. They sort of pre-announced their results last week, and we saw a surge of about 10% in its shares, and we hold that in the portfolio as well.
Now, Julia, today I wrote something in the Switzer report where I looked at some stocks that the analysts think have really big upside. And of course, these were probably calculated before Victoria went into stage 4 lockdown. But I want to look at the more risky group, because in one group, like for example, the banks have ANZ has 25% upside. I'm looking from the point of view of a longer term investor, like you were implying a moment ago. Well, in 2 years' time, you say, well, why was no buyer? But I want to focus on the ones that have really big potential gains, but could be at risk. Like for example, Webjet, 43.8%, the analysts say. Flight Centre, 24%. Corporate travel, wait for it, 67%. What do you think of those three companies? Are any of those companies the ones that you might say in 2 years' time, gee, I wish I'd bought them?
Certainly not on a short-term view. And look, I think you can be picky around your timing because they are pretty volatile. I mean, looking at these type of stocks, they fell around about 6% in one session. So if you get the timing of it wrong, that could be 6% worth of capital that you lost if you bought in on Friday. So there's no rush to get into these. But once you do see an inflection point, in 2 years' time, there's a concept called mean reversion. If you see activity levels return to pre-COVID-19, they're an absolute bargain. So look, choose your timing carefully. At the moment, the market's in the process of pricing in those stage 4 lockdowns, and that travel will be on hold for another 6 weeks, especially corporate travel in terms of business travel from Sydney to Melbourne, which is a very profitable route. So look, there's no rush to get in, but certainly there's an opportunity there if you are looking at a 2 to 5 year time frame.
Okay. I guess the last question I want to throw at you is this. If you look at the market as we see it now, are you expecting the overall index to pull back by a significant amount because of Victoria's lockdown?
Oh, look, I think a pullback is pretty normal, but I think a pullback because of the lockdown will be an opportunity to get into the market. When I see pullbacks, the question I ask is the situation permanent or is it temporary? Yeah. And the 6-week lockdown is obviously temporary, which to me represents an opportunity. There will be longer term impacts in terms of employment, in terms of solvency coming through, but these conditions won't last forever. So for longer term investors, for me, it represents an opportunity. The second thing I'm watching here is stimulus coming through from both the state as well as the federal governments, and that could be a positive thing as well. Generally, when you start to see large sums of money helping to support, that tends to signal a bit of a turnaround in terms of the market. So yes, the worst economic situation that we've seen in decades. But the question I guess investors have to ask themselves is this 6-week lockdown going to last forever? And if it's not going to last forever, then when does the buying opportunity come through? So look, in a couple of weeks' time, I'll be looking to pick up more stocks. Some sectors are more negative on, for example, the banks. I'd probably be leaving them for the time being. If I was to choose one of the big 4 banks, I'd probably go with CBA because it is due to pay a dividend in August compared to the other 3, which will pay in November. But preferring something outside of the big 4, more like a Macquarie, where I'm still pretty neutral on. I think of Macquarie as being the best house on the worst street in a falling market. So a great business, but unfortunately not the right set of circumstances.
Julie Lee from Berman Invest, thanks for joining us.
Thanks, Pete.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, we're looking at the kinds of companies that might do well in reporting season. Some might not, but certainly keeping an eye on some companies I think is a really good idea. And to do that, we're going to share some of his thoughts. Adam Dawes from Shaw & Partners. Thanks for joining us, Adam.
Thank you, Peter. How are you going today?
Very good, mate. The market has had a bit of a struggle. What's going on today?
Yeah, there's a little bit of a struggle. The bank's probably leading us lower at the moment, and then probably a little bit of reality setting in after Melbourne's now going into stage 4. People are sort of somewhat second guessing what is going to happen with this economy. So a little bit of the exuberance now starting to come out of this market.
It kind of makes sense. Melbourne is a quarter of the economy, and we don't know how bad it's going to be for the economy. It can't be positive, and it kind of makes sense that companies that operate here are going to be affected.
Yeah, agree, and especially the banks.
Yeah.
they're looking at some horrible home loans, especially in Melbourne and the rest of Australia.
Yeah, exactly right. And we all love our banks, and they're under pressure, helping to rescue the economy. Let's run through some companies that you mentioned, mate, in a note you sent to me. Fortescue and Rio. I'm actually interviewing Elizabeth Gaines on the program. Hasn't she done a great job?
Unbelievable. Did you see the debt profile for Fortescue? I think it's $300 million or that is owed. Like, I mean, that is no debt. I mean, you and I were talking on the TV a couple of years ago, and these guys were looking down the barrel of a ridiculous amount of debt.
Yeah.
They have done such a fantastic job of paying that debt down and then giving dividends back to shareholders.
Yeah, I can remember a number like 9 billion, but I might be wrong.
Yeah.
But it was huge, and it's part of the reason why I have a lot of apprehension about the company.
It's ridiculous.
But
Absolutely
she
ridiculous.
certainly has turned it around. Rio, what's your view on Rio?
Oh, look, I think it's a fantastic result that Rio put through. It is all about iron ore, let's be honest. Some of the aluminium stuff, the diamonds, things like that really does pale in significance. The the iron ore side of it has been absolutely fantastic. I think they'll be a little bit light on the dividend. We never buy resource stocks for dividends, but I do think that dividend is going to be a little bit lower than potentially what the market's thinking of. I'm a little bit hesitant to be buying it up here at $100, $105. I just sort of get that feeling that it could potentially come back a little bit as well. And I think it's probably better trading at around the $90 level. But look, all in all, it's been a fantastic result, fantastic business, and they're literally going from strength.
Okay, now in your note you say that strong growth outlook, and you've named A2 Milk and Afterpay.
Yeah.
Are you saying that there's still buys at current levels, Adam, for the person who's prepared to wait a year or so to see the share price keep on rising?
Look, I think so. I think A2 Milk has got a fantastic balance sheet, fantastic management, and has really done very, very well through this COVID experience. So really, it's gone from strength to strength. And I think that shows resilience in a business where the weak ones will always fall off. The weak ones will always will disappear. It's the strong ones that will survive. Afterpay, again, has done a very, very, very good job at what they've done. And I do think that they will beat the numbers on their total transactional values. I think A2 Milk is a fantastic business, good balance sheet. So, yeah, I'm comfortable. I wouldn't be putting all my eggs in the one basket, but I'd certainly be chipping away at here for a fantastic result, especially to the upside on A2M. I think that's definitely.
Okay. Now, under the heading of positive trading update, you've got Domino's, but Domino's haven't reported yet, have they? But this is your anticipation that they will actually have a positive trading update.
Yeah. Look, the whole work from home, or in fact being the whole lockdown, and then they've done a lot of advertising around contactless, get you delivered, no contact, all of those kinds of things. Look, I think they'll do very, very well. They've got a fantastic business model. You will see that home delivery. Look at Marley Spoon. Triple M is the stock code. That thing has just gone absolutely ridiculous. I really do think that home delivery section, and Domino's certainly in the front seat, I think they will surprise the upside.
I'll tell you one unusual, well, I don't know if I can call it an economic indicator, but it is. Apparently, tailors are just run off their feet with people increasing their waist size on their suits because they're sitting at home eating things like Domino pizza.
Well, it's probably right, isn't it? We're all getting a little bit older and a little bit fatter, so buy some ResMed. You'd be good with that.
Okay, they'll have your positive ones. Is there another company that you really have a good positive feel about that you'd like to mention before we look at the negatives?
Yeah, look, I'm liking Amcor.
Yeah.
I think this one will do really, really well also. I mean, it's in packaging. It's the sort of upstream from the Woolworths or the Coles. They need, I mean, as obviously packaging is a fantastic business, and it's very defensive as well. So I really do see Amcor, and even Aristocrat probably should do quite well on that social gambling or that gambling side of things, not from the pokies, but from the other side of that online gambling that they've done very, very well on. So I'm looking for some positive results on those as well.
So under the heading of challenging fundamentals, you got Origin.
Yeah. Well, yeah, you want me to talk Origin?
And you've got Cube, and you've got Woodside.
Yeah, we'll see Origin and Woodside in that oil and gas space. Origin's got the retail side of things. I think Origin's going to struggle with people potentially not being able to pay their bills. Yep. So that's the first thing. And then Woodside in that oil and gas space, we're using less cars. Well, we're not. The airplanes aren't flying. Oil demand globally has slumped, and I think that's probably a good thing. And but I think that's going to be challenging results, and we just need to be careful. Woodside's already had a big downgrade, so it's probably well known to the market. But I just think there might be something coming out of left field for those.
And Adam, it can
be a little bit tough.
Adam, is it fair to say that if we thought the worst of the coronavirus was behind us, and that the threats from second wave infections was really low, a company like Woodside would be a beneficiary because we would be out and doing stuff again, we would be flying? Is that the kind of thinking that a novice to investing should be thinking about?
100%. You'd be planning for the future, and you'd be planning 12 months in advance. And Woodside is a buy 12 months in advance. I just think this reporting season, this time round from the 1st of Jan to the 30th of June, this is where things are going to be a little bit tougher. And I think Woodside is definitely going to struggle. Demand's not there. As soon as the planes start moving in the air, you watch the oil price back up to $50, $60, $80 a barrel, and it'll be on again. So it's a really good time to be looking at Woodside and accumulating at these lower levels.
Yes. So that was the point I wanted to make out, because some people often don't understand that when someone like you makes these sorts of comments, they aren't necessarily for the long-term trades, for the shorter-term trade. But when it comes to the longer term, WPL or Woodside is not a bad buy.
Balance sheet's fantastic, dividend will be there, and they've got a little bit of growth coming from Scarborough. But yeah, it's one of my top picks in the oil and gas space.
Okay. Let's just deal with a couple that were also in your negative areas, but they're fantastic companies, namely Cochlear and CSL.
Yeah, so I just think, well, Cochlear, I think, has been, that they've raised some capital. I think, it's a very, very good business. I just think that they potentially might struggle for the cost of the implant that they put into the ear is not discretionary spend. It is more discretionary, it's not staple. So it's going to be tough for them to keep that level of, and it's not government supported in a lot of countries. So you have to have a fair bit of cash to do that. So that one. For CSL, I think it's going to struggle for its collection depots. In the US, you have to get blood and you go in and get paid for that. So their collection depots are going to be a little bit tougher, and so hence earnings. And there's going to be a bit of a drag on earnings. So for both those companies that are market darlings, and certainly when we see that potentially companies aren't going to report as well, they do get hit when they have a little bit more of a negative stand.
But
so I'm just a little bit worried about that.
But as a long-term play, at what kind of price would you pile into CSL?
Well, look, it held that 270 really nicely today, and that was a big telltale sign for it to continue doing well. 270, if it breaks 270, it's down to 250 and then 242, which is March 23 lows. So they're the kind of levels that you'd be looking for. But if it holds 270, I think it should do well here and head back up 300.
If it gets to 250, mate, I'll even put your money into CSL. That'd be a good price.
Yeah, everybody heard that. Everybody heard that.
Okay, mate. Adam Dawes, is there anything else you'd like to throw in before we wrap it up?
Look, I think everyone needs to basically keep calm through this August period. As you know, and I know, as students of the market, this is going to be unprecedented times. So just be cautious. Don't follow the herd. Don't jump out when you see a bad result. Wait till the dust settles, and just keep a cool head, because it is going to be a tough reporting season. But I think sanity will prevail. And everybody keep calm, because I think it's just going to be one of those tough ones.
That's the very calm Adam Dawes, except when he's chasing his children around soccer fields. Thank you, Adam.
See you later. Take care.
Welcome to the program, Elizabeth.
Great to be with you, Peter.
And I'm reading from your press release, outstanding operating performance in Q4, contributing to record shipments to FY20, lower C1 costs and increased revenue realisation. You really are crowing about a great result.
Well, it's a result of the whole team, so I'm so proud of the team, Peter. And it's in the midst of what has been a pretty disrupted calendar year at least, we saw in that June quarter that our team really responded. We had to put in place a range of measures to deal with COVID-19, including extending our rosters from 2 weeks on, 1 week off, to 4 weeks on, 2 weeks off. And that was a huge ask of our team members. So the fact that they were able to deliver a record June quarter, which built on the success of the first 9 months, meant that we delivered a record year of shipments of 178.2 million tonnes. And the highest we'd shipped in the past in a financial year was 170.4. So a significant uplift in shipments.
Okay, so, Elizabeth, I always try to represent the kind of shareholder who invests in a company like Fortescue, and I know my Switzer report has never been negative on you guys, since you've been around anyway. But here is, I think, in reading this press release, there's so many good things in here that have happened. But what is your most important KPI, and how is that done in this reporting season?
Most important KPI for me, I don't even think of it as a performance indicator, but is safety, Peter.
Yeah.
The safety of our workforce is our highest priority. And the fact that we've seen our lowest ever total recordable injury frequency rate down to 2.4, which was a 14% improvement on FY19, I think, again, during a period where we had that disruption, just goes to show that the team are sort of really focused on safety as our priority. So it's not about shipments at any cost. The safety of our workforce is number one, front and centre. So for me, that we've got a goal of zero harm. So it's actually not about numbers.
Yeah.
2.4 is a measure, but our goal is zero harm. But of all of the records that we achieved in FY20, certainly safety stands out for me.
Okay. Well, I'm going to have to ask you a follow-up question. What's the second most important KPI that you think that the market really takes? You know whether the market's going to be good to you or bad to you. Which one is the second most important KPI?
Well, it's probably two. It's hard to choose between shipments and our costs because clearly, volume is one part of the equation, but because we are the lowest cost producer, we're generating very strong margins, and those cash margins are quite phenomenal. And so we saw $4.9 billion cash balance at the end of June. And during the quarter, we paid our interim dividend to our shareholders of 76 cents Australian cents, which was about $1.4 billion US. So returns to shareholders are actually a function of how much do we ship, at what cost, and really that's what drives those very strong margins.
Yeah, and what is the outlook for those then? Because when you do really well, can you keep on doing it?
Well, we've guided to shipments in the range of 175 to 180 million tonnes for FY21. So at the top end of that range would be a bit ahead of FY20. And our C1 costs, we've guided a range of $13 to $13.50. And that does include some ongoing costs associated with dealing with COVID-19 around cleaning and hygiene and some of our testing. So, yes, we are still very focused on doing more. We've really saw some records across not only shipments but also processing, rail, all of our integrated infrastructure. And we do own all of our assets through from mining, processing, getting it railed and also onto a ship. So the fact that we own that fully integrated supply chain means that we're actually able to get those efficiencies. So we're very focused on optimising our existing assets and delivering on our guidance for FY21.
Your Rio rival was very bullish on China. Do you agree?
Well, we've certainly seen a very strong recovery in China, and crude steel production in the first half of this calendar year is at nearly 500 million tonnes, so 499 million tonnes. And that's a 1.4% increase on the first half of calendar year 19, during a period where China had its own lockdown and a very tight lockdown. So even during that first 6 months when there were COVID lockdowns, we saw strength in crude steel production. And our exposure to China is largely through iron ore and therefore steel production. So we're continuing to see that underlying strength. We see continued investment in infrastructure, the underlying strength of that Chinese economy. And, for Australia, the month of June was a record for iron ore exports with with 9.92 billion Australian dollars of exports to largely to China. So it's really important to the Australian economy as well.
Yeah. Look, I know you've been in business for a long time, and a lot of people don't know that for your punishment, you actually are an accountant, aren't you? A chartered accountant, if I remember rightly.
I am. I am.
You've thrown off that tag very effectively, but not that there's anything wrong with that. But but when you studied to become an accountant, I don't think you ever would have thought that you had to. I know at university when I was lecturing, I never ever lectured on pandemics, but with a pandemic like this means that one of your rivals, Vale, clearly has issues because of the pandemic, and it's had an implication on prices. So when you try to work out the future of your company, do you have to try and factor in, the course of the pandemic in Brazil and its implication on Vale and therefore prices?
Well, I think all those factors are taken into account, and there is Vale themselves in their guidance have indicated that they've already allowed for some additional COVID impacts. And I think one of the things that's probably less well understood is the difference between the operations in Brazil, where largely the workforce drive in, drive out. Drive in every day, work their shift, drive home to their community. Australia, for iron ore producers, is quite different. We're a fly in, fly out, and generally it's 2 weeks on, 1 week off. We extended that during the June quarter. So they're quite different operations in some respect. But getting back to that sort of supply and demand, the broader impact actually was in January 2019, when sadly Vale suffered that terrible tailings dam failure. And that really had a 90 million tonne impact on their supply. And really that hasn't been fully recovered. And I think COVID's been another impact as well, plus some weather impacts earlier in this calendar year. So there's been a range of factors that sort of go into the mix of supply disruption versus that strength we're seeing in demand. So obviously we stay close to the market and we understand what's happening. But I mean, underpinning all of that, we're seeing that growth in Chinese crude steel production. And even if China's crude steel production grew by between 1% and 2% a year, they would still need another 30 to 50 million tonnes of iron ore supply every year. So there's ongoing strength, there's ongoing demand, and there has been a scarcity of supply. Yeah.
So therefore the question I'm going to ask now is the same one I'm sure Josh Frydenberg has given you a call to see if it is the case. Do you have confidence that the price of iron ore is going to, at least stay around current levels?
Well, I've learnt never to predict the iron ore price, Peter. So
I knew you'd say that. I knew you'd say that.
Everything is indicating, whether it's stockpiles in China, whether it's current shipping rates, everything is indicating that there is a strong ongoing conditions and importantly strong ongoing demand for iron ore. For us, by staying focused on being the lowest cost producer, we're generating those strong margins regardless of where we are in the cycle.
A few years back, there was question marks over the calibre of your grade. What's the situation of that nowadays?
Well, we've made some really fundamental changes to our product strategy, and I think that's part of what we're seeing reflected in the strength of our performance, but also our share price. I think the market is recognising that we have a clear strategy, and our strategy is to get to the position where the majority of our products are greater than 60% iron grade. We introduced West Pilbara fines in December 2018, and that's a 60.1% Fe grade product. And we've grown volumes of West Pilbara fines in FY20. We also have our Iron Bridge project, which once delivered in 2022, will add 22 million tonnes of a 67 grade product. So we're on we've got two major projects currently in construction. They are growth projects and they will also enhance our overall grades. So we're very different to a few years ago where we had three key products. We've added West Pilbara fines, we've added Fortescue lump, and then we will add Iron Bridge magnetite as well. Yeah.
So in terms of your diversification, you're saying that there's been substantial progress.
There certainly has been substantial progress in our iron ore business. Not sure it's diversification in the true sense of the word, but certainly in terms of that overall grade strategy. And magnetite is a different product to existing hematite operations, so that will be in addition to our overall iron ore product suite.
Right. My colleague here on the Switzer investing program, Charlie Aiken, has often used the old rule of thumb that you don't invest in a mining company for dividends, but in recent years, the mining companies, iron ore mines in particular, have been great for dividends. you have confidence in the dividend you're paying that's going to be around for a year or two at least?
Look, I think that we've demonstrated that we've got a very disciplined capital allocation strategy. We had peak debt of $13 billion. We prioritised debt repayment and we repaid $9 billion of our debt. We've now got a balance sheet that is on investment grade terms and conditions. So we're very comfortable with the strength of our balance sheet. And now we've been delivering significant returns to our shareholders. And I'm kind of repeating myself about our low cost position, but by being the lowest cost, we're actually generating very strong margins. And we have a policy to pay out between 50 to 80% of net profit after tax.
Very good. One last question. You mentioned COVID and how the team has responded really well to it. One thing I've noticed is that business owners, business managers have also learnt from this coronavirus threat, and they're doing business differently. Like, for example, I'm finding it easier to get great CEOs like you on my television program, courtesy of Zoom. Once upon a time, we had to sort of try and get a camera in there and all that sort of stuff. So we're all becoming adaptive. And so I've got a better TV program because of the coronavirus challenge. What has Fortescue learnt from this experience that you'll take forward to actually be a plus for the company?
Well, I think there are some measures around. I mean, we've even seen lower rates of flu and other illnesses during this winter season. So clearly some of the measures we've put in place as a broader community, but across our sites through the hygiene and other cleaning practices are all adding to the health and safety of our workforce and to productivity. So some of those measures, having that flexibility where people can also work from home. We are actually back in the office, but we have flexibility as well. We can, we've got enough floor space to have appropriate physical distancing. So we're back in the office. So it's that flexibility. I think you're right. One of the other reasons you're probably able to get us on the show is we're not travelling as much. So we're able to do more business. We're focused on the business and being in the business and present in the business rather than necessarily some of the other kind of travel-related activities. And there's a balance to that because at some point, we want to visit our customers in China, for example. So, but I do think that some of that flexibility that we've all learnt, the ability to be part of the business, whether that's virtually or in person, and to actually really focus on the business, I think it's been a key learning as well.
Elizabeth Gaines, thanks for joining us on the program.
Great to be with you. Thanks, Peter.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, you heard earlier that Adam Dawes thinks that Afterpay is a buy, but my next guest, Paul Rickard from the Switzer report, controversially is saying it's a sell. But Paul, how controversial are you being? Are you a man on your own, or do you have a bit of support out there?
I'm not a man on my own, Peter. There's a huge divergence amongst analysts. You rarely see these type of numbers. So Aftertrade at the moment is trading about $66. We've got two really well-respected brokers. One, Morgan Stanley, says it's a buy. They've got a target price of $101.
Huge.
And UBS still has a recent target price of $26. So
that's an enormous difference.
You don't get that sort of numbers. And I think this is part of what I describe as sort of, look, the buy now, pay later sector, they've done really well. You have to give the guys at Afterpay a lot of credit, particularly the way they approached the US market and really revolutionised how a lot of younger people shop in Australia. But the whole sector just ain't worth what it's worth. I think it's just way overvalued, Peter.
Okay, so we've seen that CBA took a 5% share in a Swedish company called Klarna.
Yeah, so Klarna's about 3 or 4 times the size of Afterpay in terms of it's got 84 million customers it's more than that. 84 million customers globally versus Afterpay's about 10. Its revenue of $750 million versus Afterpay's revenue of $300 million, and it's growing at an even faster rate in the US than Afterpay is, about 330% compared to Afterpay's 320%. CBA bought effectively, almost 6% and has paid $300 million, which values Klarna at about $8 billion. That's Australian dollars, versus Afterpay's current market cap of about $20 billion. So
$20 billion.
$20 billion. So Afterpay, in a market cap sense, is twice as big. But Klarna's got 8 times the customers and making about 2.5 times the revenue. So I think the market's a little bit out here, Peter, and that's what brought it home to me. I mean, I'm not going out to say Afterpay's a sell because per se, but I just think when you get that sort of divergence with Analyst, and you look at the CBA, you look at their investment in Klarna. Now it's privately owned still, but it'll come to it'll list at some stage. I just think we're just way ahead of ourselves in Afterpay.
How important is the Australian market to Afterpay?
Look, not that important. It isn't at the moment in terms of still generating revenue, Peter. But growth in Australia is slowed down. But you expect that. It's the Afterpay story is really about the US market and to a secondary extent the UK, but it's mainly about the US market. That's why people have paid the top dollar. It's why people like Tencent have taken a 5% stake. So there's been some good names coming in. So don't get me wrong, I don't think Afterpay is going to turn around and vanish. This company has done really well, but at $66.50, I'd rather find something else.
So you think the UBS value is too low and the Morgan Stanley one's too high? When would you buy Afterpay?
I'd probably be looking more back in the mid 30s to 40s. I mean, I think it's got to come back into range a little bit. I mean, it is I would say it is a bit of a bubble. And look, a lot of the institutions just got in. Afterpay did a capital raising just at the start of July, raised $650 million at $66 a share. So the instos are still getting into it. So that's one of the reasons why it almost looks like it's got a bit of a floor here. But I think I think there'll be markets will reassess at some stage, and I think if I was a holder, this is where I'd be getting at. I'm not saying it's the top because speculative bubbles, it's really hard to say the top, but I wouldn't be buying Afterpay or Zip at these sort of prices. I'd be waiting.
Okay. Now, while we've got Paul Rickard in a very controversial mood, I mentioned earlier in the show, Paul, about some of the companies to look at with reporting season, and I listed a whole lot of companies that are well-known companies with potentially, 15 to 19 to even 30% gains. But I said there's a second group which are much more vulnerable with really big gains like Webjet, for example, 43.8% analysts on FN Arena think, and corporate travel, 67%. Do you worry these companies might have trouble surviving?
Yeah, I do, Peter. I mean,
controversial, I said.
I don't want to put the mocker over any of them, but I am worried about that whole travel sector. I'm not worried about Qantas. There's always going to be airlines that think at some stage. So look, Qantas might do it really tough, but I'm not worried about it. But I am worried about I would describe as the travel agents and the bigger brothers in terms of the Webjets, the corporate travel. You might also argue Flight Centre. This whole thing could last some years. And if it lasts years, it's going to be really hard for these companies to survive. So, they basically rely upon international travel. They rely upon us wanting to go there and get their help, or corporates to make it easier for, a lot of their business does come from corporates, but none of us is flying. And if this thing stays locked down for 12, 18, 24 months, I don't know how long they can survive for. So I am worried about those. I think buying them for a dip, for a rebound, you've got to be a brave investor.
Or be willing to wait a long time.
Yeah.
But the bravery aspect is you do think these companies could be vulnerable if they're not bringing revenue in for a long, long time.
Well, I mean, you can only pay the bills for so much. There's only so much capital you can raise. You do need revenue. There's only so much JobKeeper to go around. I mean, so I do worry about these companies.
And what about Star Group?
I'm less worried about Star. I mean, look, I think the assets here in Sydney and in Queensland. Look, domestic tourism can fill part of this. Look, I'm not as worried about that company. I know you've also got Nine Entertainment up there, Pete. Yeah. I thought that was an interesting one. I'm not as worried about that as perhaps as you.
That's why I threw them in because it's a big number, and that makes you think as though it's risky. But I think Nine's diversifying quite effectively. But they do have a lot of challenges out there with the pay TV rivals. But I thought it was interesting, and I'm basically saying to everyone, watch it. let's just see what the CEOs say in the outlook statements, because that's going to be really important.
I think there's a bit of an ego factor that goes into things like television, and when I mean an ego factor, there's always a buyer. There's somebody who'll want to have influence over the news or own the best quality papers, a bit like Jeff Bezos and the Washington Post.
Yeah. There's
a value of these assets. They may not be able to make any money out of them, but there's some type of value. So I'm much less worried about that as surviving than perhaps a company that's a service business and really relies upon you or I and corporate Australia, whatever it is, to using their services to find a better deal, a better way to do something.
Yeah.
So I think you've got to be a little bit careful because we're in unknown territory. And someone said maybe the first time we saw the virus was actually this is really the wave. That was just the warm up. Let's hope not. Wow. But I think we've got to be just a little bit careful, and you're going to want to be. Put these in your speculative part. These aren't core stocks in my eyes at the moment.
No, exactly right. And if you want to read more, the Switzer report, both Paul's story on Afterpay and my story on those companies, promising big returns, are in the Switzer report. And you can check that out at switzerreport.com.au. And that's the show for tonight. Just before I go, I did mention earlier that there were X free days trials for the Switzer report. My sidekick here, Andre Chan, has checked it up. It's 21 days free trial for the Switzer report. So go to switzerreport.com.au. You can see the story from Paul on Afterpay and mine on those companies that look like they've got really big upside, but that might take some time before it actually happens. Thanks for joining us. See you next week.